Hello, everyone. Good morning and welcome to Daily Trader with Kevin Hincks. I'll be taking you through the next 10 minutes or so. We're going to look at the economic data, and then we've got two trades on two key names going on in the market right now. Microsoft, that had earnings yesterday, and we're going to talk about the effects of that, and Boeing, that is in the news as they may have come to a resolution on the labor strike. But let's first get to our macro minute. Today, non-farm payroll day, the number one data point of the month in terms of looking at the overall stock market. Non-farm payrolls, 12,000. Why? And at taping here about an hour into the trading day, why is the S&P and NASDAQ up a full percent with 12,000 payrolls? Well, I'll give you that in a minute. The non-farm payrolls were plus 12,000. Unemployment rate, 4.1%. Private payrolls down 28,000. Manufacturing payrolls down 46,000. The wage data up 0.4 month over month and 4% year over year. Here's some of the key aspects that may help you digest some of this data. Number one, 2 strikes and 2 hurricanes are skewing the economic data. How do I know that? The manufacturing data down 46,000 jobs, negative. 44,000 of that attributed to strike activity. How about this? Temporary help services jobs down 49,000, and since its peak in 2022 has lost 577,000 jobs. How is that offset? How about the government? Government added 40,000 jobs, and for the last 12 months, they've averaged 43,000 jobs made by the government for a total of 516,000 jobs. Healthcare added 52,000, but this is a number skewed, messy data brought on by 2 labor strikes and 2 hurricanes. So that's why the market is more or less discounting some of the data. Now, let's get to our trades today. Microsoft, as you know, came out with the earnings yesterday, and the stock was down significantly. And if you look at a long-term chart of Microsoft, this stock from the date of right around mid-July, when it hit $468, you could see it there at that peak, is down more than $60, was down at its low yesterday at $406, down more than $62 off its lows. This is Microsoft. They had earnings of $3.30 versus $3.08 expected. Revenue $65.6 billion versus $64.4 expected. The revenue growth, 16%. Think about this. In the last 10 years, they have more than doubled their revenue growth. Microsoft. So this is a big, large cap tech company that is acting like a small growth company because they continue to grow despite their size and all the businesses that they're in. What else? They're unfazed by everything that's happened in the last years. How about COVID? How about supply chain problems? How about inflation? How about interest rate hikes? How about wars? 2 different wars going on. Microsoft unfazed and continues on its path to incredible growth. So, therefore, I think you look at this sell-off, and the stock's already higher this morning. It's up almost $6 this morning. So what I did here is, for today's trade, this is called an unbalanced butterfly. Now, I went out to November 29th. So November 29th is 28 days, a full month from now. And what I did, I looked at, for a paper money trade, I bought the 410 call, sold 2 of the 430 calls for a $20 call vertical, and then bought 1 of the 435 calls. So I'm long a $20 call vertical, short a $5 call vertical. The net debit there, about 670. As we get it, it's trading a little higher than that. We've got it in around 670. It's trading a little bit higher. But what this does, it gives you about 22 long deltas. And for the next month, if Microsoft were to move back up towards $430 from where it is now, about $412, this trade has a chance to be extremely profitable. Now, the risk on this trade, what you pay for it, right? But you're paying $6.70 for a $20 call vertical, but you're also selling a $5 call vertical. You see the peak there of that profit graph? That's at that short strike of $430. Where does it come back down? That's $435, but then it flattens out. So you have profits of about $800 per trade if it continues to go higher. Now, if it were to settle near the 430 strike in the next month, then you would have the benefit of, think about this, the $20 spread goes to somewhere around $20, and the short call vertical goes to zero. So that's where that peak would come in the unbalanced butterfly. But it's a $20 call vertical, financed or made less expensive by a short $5 call vertical, and that's out 28 days from now. So November 29th expiration. Okay, there's our paper money trade for today in Microsoft. The next one, Boeing. Now, Boeing's been very interesting because the original vote on a labor deal was voted no by 96%. Then the second one was 64%. Now, this new deal with a 38% pay increase over the next 4 years, a $12,000 ratification bonus given out. The workers' union has endorsed it. They vote November 4th, which I believe is Monday. They'll vote on this, so it could come as early as Monday. The Boeing workers in the Pacific Northwest has been on strike for 7 weeks. So I think they're probably anxious to get back. They've got a 38% pay increase over the next 4 years. So Boeing was able to raise money in the debt markets and the raising equity in the stock market, and they need to get back to what they do best. The best thing about Boeing and the reason they were able to raise this money so easily is they have a massive backlog of plane orders. They have a new CEO who comes from the engineering side of the business. He's located now in Seattle, so he'll be in the plant where the things are happening. Boeing, this could be the start of the turnaround story in Boeing finally as the news starts to shift. So the trade that I looked at in Boeing is something in the diagonal family. You see it a lot because it's in the calendar spread family where you buy longer dated options, sell shorter dated options. You're collecting theta. The risk is the debit paid on this spread. In this case, I went out to November 22nd, just 3 weeks from now, and I bought the 150 call. Then I went out to next week's expiration, November 8th, and sold the 157 call in line with the expected move, which is about $8. So buying the 150, selling the 157. Now, you could adjust this maybe and do the 150, 152.5, remember, the lesson here is the diagonal. If you think the trades or the strikes aren't different and you want to adjust the trades, that's every individual investor's prerogative to adjust the strikes. But what I looked at here is a 3-week, actually it's only a 2-week because you're selling November 8th, buying November 22nd, so it's a 14-day trade. That's $7.50, the width between the 150 and 157.5. You're paying about $550 for it, I think is where I have it, $550. $550 debit. I think it's trading a little higher than that now, but here's the thing. Remember, it seems like you're paying a lot for this, but you get the opportunity to extend duration, right? Once into the November 15th, and then if you wanted to make it a vertical spread, you could extend duration into the November 22nd expiration. So there's each time you do that, you chip away at the net debit. You also chip away at the break even on this. So we had 2 trades today. We looked at an unbalanced butterfly in Microsoft, kind of a long-term trade, a full month, and then a 2-week trade in Boeing doing a diagonal, buying the 150 call, selling next week's 157. Do you want to look at different strikes? You can absolutely do that. Play with it on the risk profile on the Thinkorswim platform. And everyone, Have a great weekend. Monday should be a fun day. Next week, more earnings to come. We're getting through a big week of not only large cap tech earnings, but also non-farm payrolls and a lot of economic data. So you have the election on Tuesday. You have Jerome Powell Fed meeting on Thursday. So a lot coming up on the horizon. That's it for Daily Trader today. Have a great day, everyone. I'm Kevin Hincks.